Vince had always dreamed of financial freedom. He wanted a steady income without the stress of working a traditional job forever. After exploring different options, he stumbled upon dividend ETFs, a way to earn passive income while letting his money grow over time. Excited by the idea, Vince started researching the best dividend ETFs and kept seeing the same three names: VYM, Vanguard High Dividend Yield ETF, SCHD, Schwab U.S. Dividend Equity ETF, and VIG, Vanguard Dividend Appreciation ETF. But choosing the right one wasn't as simple as he thought. Each ETF had a unique strategy, and Vince needed to figure out which one aligned with his goals. Before jumping in, he reminded himself of the golden rule of investing: understand where your money is going. He didn't want to blindly invest. He wanted to make an informed decision that would benefit him in both the short and long term. What are dividend ETFs? Dividend ETFs are funds that invest in stocks that pay dividends, providing investors with regular income. Instead of buying individual dividend stocks, ETFs spread the risk across multiple companies, making them a safer option for beginners like Vince. There were a few key things Vince learned about dividend ETFs. Some focus on high dividend yields, meaning they pay out more income immediately. Others focus on dividend growth, meaning they invest in companies that consistently increase their dividends over time. The best dividend ETFs offer a balance between income and long-term value. With that in mind, Vince took a closer look at the three ETFs to see how they compared. VYM, Vanguard High Dividend Yield ETF. VYM is designed for investors looking for high dividend income right away. It holds stocks of large companies that pay above-average dividends, making it ideal for those who want strong cash flow. Key features: higher yield than most dividend ETFs. Top holdings include Johnson & Johnson, ExxonMobil, and Procter & Gamble. Provide stability by investing in established companies. Why investors like it? VYM appeals to investors who want passive income now rather than waiting years for dividend growth. Since it focuses on companies with strong financials, it also provides a level of safety. However, Vince noticed one drawback: VYM prioritizes high yields, but not necessarily dividend growth. That meant while it paid a strong dividend today, it might not grow as fast as other options. Still, he kept it in mind as a potential choice. SCHD, Schwab U.S. Dividend Equity ETF. SCHD is another popular dividend ETF, but it takes a different approach. Instead of just looking for high yields, SCHD selects companies based on dividend quality, financial strength, and long-term growth. Key features: focuses on dividend growth and stability. Invests in financially strong companies with a track record of consistent payouts. Lower expense ratio than VYM. Why investors like it? SCHD was a strong contender because it balanced dividend yield and growth, making it attractive for investors who wanted income now and increasing payouts over time. Vince saw that SCHD might be a better long-term play than VYM because of its emphasis on quality over yield. Instead of just choosing companies with high dividends, SCHD focused on businesses that had strong fundamentals and sustainable payouts. The only downside: its dividend yield wasn't as high as VYM. That meant slightly less income up front, but more potential for growth in the future. VIG, Vanguard Dividend Appreciation ETF. VIG had the lowest dividend yield of the three, but it offered something unique: companies that consistently raise their dividends. Instead of focusing on high-paying stocks, VIG prioritized businesses with a history of increasing dividends every year. Key features: invests in companies with a strong history of dividend growth. Lower volatility compared to VYM and SCHD. Prioritizes companies with strong balance sheets and stable earnings. Why investors like it? VIG wasn't the best choice for those who wanted immediate income, but it was great for long-term growth. Companies that consistently increase dividends tend to outperform the market over time. Vince liked the idea of investing in stable companies that grew dividends consistently, but he also knew that VIG wouldn't provide the same level of passive income as VYM or SCHD. Making the right choice. Now that Vince understood the differences between the three ETFs, he needed to make a decision. VYM was great for immediate income, but lacked strong dividend growth. SCHD offered a balance of income and growth, making it a strong long-term choice. VIG focused on dividend appreciation, which was great for long-term investors, but not ideal for those looking for immediate income. As he sat down to plan his investments, he realized he didn't have to choose just one. Instead, he could combine all three ETFs to create a balanced portfolio that met multiple goals. Before diving in, he reminded himself of an important step. Subscribe to Finance Family for more insights on building wealth and generating passive income. Now, Vince needed to decide how he would allocate his investment across these ETFs. Would he prioritize higher yields for more cash flow now? Or should he focus more on dividend growth for the future? He had some choices to make, and each would play a key role in his financial journey. Vince knew that choosing the right dividend ETF could make a huge difference in his journey toward financial freedom. He had already researched Vanguard High Dividend Yield ETF, VYM, Schwab U.S. Dividend Equity ETF, SCHD, and Vanguard Dividend Appreciation ETF, VIG. Now, he needed to decide which one aligned best with his long-term goals. Understanding dividend yields and growth. Vince's first priority was ensuring a steady stream of passive income. He compared the dividend yields of each ETF. VYM had an average dividend yield of around 3.0% to 3.5%, making it one of the higher-yielding dividend ETFs. SCHD provided a similar yield, averaging 3.2% to 3.6%, but it focused more on companies with a strong track record of consistent dividend payments. VIG, on the other hand, had a lower yield of 1.5% to 2.0%, as it focused on companies that increased dividends over time rather than offering the highest yields up front. For immediate passive income, VYM and SCHD were clearly the better choices. But Vince knew that yield alone wasn't enough. He needed to look at long-term growth potential too, evaluating historical performance. To understand how these ETFs performed over time, Vince looked at their 10-year performance. VYM had seen steady growth, though it occasionally underperformed the broader market. SCHD had outperformed many dividend-focused ETFs, delivering returns that were almost as strong as the S&P 500. VIG had the highest total return, as its focus on growing companies allowed it to benefit from capital appreciation. This analysis made it clear VYM and SCHD were better for passive income, while VIG offered stronger long-term growth. Risk and stability considerations. Vince also wanted to make sure his investment was safe, even during market downturns. VYM, with its focus on high-dividend stocks, had somewhat higher volatility, especially in bear markets. SCHD provided strong risk management, as it only included companies with solid financials and sustainable dividends. VIG had the lowest risk, since its holdings were large, stable companies with a long history of increasing dividends. If Vince wanted more stability, SCHD and VIG seemed to be the better choices, creating the perfect ETF portfolio. Rather than choosing just one ETF, Vince considered a diversified strategy to balance income, growth, and risk. Portfolio Option 1. Maximizing passive income. If his main goal was generating income, he could allocate his investments like this: 50% in VYM for its high dividend yield, 40% in SCHD for strong returns and stable dividends, 10% in VIG for future dividend growth. This mix would allow him to earn strong dividend payments now while still benefiting from future growth. Portfolio Option 2. Focusing on growth and stability. If Vince was more focused on long-term capital growth, he could adjust his strategy. 20% in VYM to provide some income, 40% in SCHD for a balanced approach, 40% in VIG to maximize long-term wealth growth. This approach would reduce risk while still allowing for strong returns over time. Making the final decision. After reviewing all the factors, Vince realized that no single ETF was perfect on its own. A combination of VYM, SCHD, and VIG allowed him to create a well-balanced portfolio that aligned with his financial goals. He finally felt confident in his decision. By choosing the right mix of dividend ETFs, Vince knew he was setting himself up for a future of reliable passive income and long-term financial growth. If you found this breakdown helpful, make sure to like, share, and comment below with your thoughts on these ETFs. Which one do you prefer?